Yeah, I'm excited to chat. We talk often about the market, cybersecurity market, and things like that. But you put out, a lot of great content on return on security. But in particular, you put out this great report called 2024 Cybersecurity Market in Review, State of the Cybersecurity Market in Review, which we're going to dive into today. But for folks that didn't catch you on the show previously or don't follow you, can you tell us a bit about your background as well as return on security?
Yeah, absolutely. So background is spent all my career in cyber. So security engineer all the way up to CISO in a few places and kind of everything in between. And then along the way, I just started really caring about, external kind of facing products and what the market looked like and how startups were upending incumbent players. And I just formed a lot of opinions over the years because I either personally ran teams that had to deal with all the security engineering technology, or I had to, work with teams who were influencing that aspect of what they buy and what they bring in and what they take out of the company. And so it just kind of formed into this, I would call it niche obsession about the financial happenings and the economic happenings of our industry. And then it just evolved into me starting to write about it every week, and it's snowballed from there.
Yeah, I came across you for that very reason. It's like, I've been in security a long time, but I never kind of looked at the market of security itself. Like I'm kind of down in the weeds in the technical stuff or, whatever the issue of the day or the month is, in cybersecurity, but never looking at the broader market and how we kind of operate in terms of products and services and vendors and consolidation and M&A and private equity and all the things that, we'll probably touch on throughout this talk. And I think more and more people are starting to realize that cybersecurity isn't just a career field, but it's also a market in and of itself. And people like you are doing some great work to bring awareness to that. So that said, let's go ahead and dive into the State of the Cybersecurity Market 2024 in review. And we're going to kind of walk through it in different sections of how you broke it out. You have, kind of funding trends, M&A trends, AI and security, products and services, and then geographic trends. And of course, public markets for, those large companies that kind of dominate the ecosystem. For better or worse, I'll have some commentary on that when we get to it. But yeah, let's get going, man. So you start off, kind of talking about layoffs from the previous year. We did see, quite a bit of layoffs in 2023 and 2022. Companies letting a lot of folks go. People out there looking for work, and it was weird because we saw this happening at the same time of we're still hearing that recurring theme of the cybersecurity workforce, shortage, and we don't have enough people, and all the things that we hear all the time in cybersecurity. But here we are seeing a lot of organizations letting people go. But I'm curious, it looks like it dropped, nearly 70%, which is a great news for people in the workforce. But why do you think that was? What did you make of this data as you were digging into it?
Yeah, honestly, it was pretty surprising because the peak of the market layoffs happened at the peak of the funding as well in the industry. So it was a bit of a contradiction in that the industry raised more money than it ever had, but also had more layoffs than it ever had because they effectively overhired for worse than they ever had. And then, when the global economy kind of went to a screeching halt in 2022, mid 2022, with interest rates going up all over the world, it became a lot more expensive to lend money. And then companies at the same term stopped buying things as often and closed all their open roles, started laying people off, not just in cyber, but it also, lots of industries outside of cyber. And it just sort of created this cascading effect of like pullback. And so big layoffs in 2022. And then those people tried to survive until 2023, didn't really work super well a lot of times. So even more layoffs in 2023. But the good news of 2023 is towards the tail end of the year, people had sort of acclimated to, well, things are different now. We have to think about company formation, company profits, company strategy differently. We have to take money differently. Investors surely changed how they thought about lending money. And so all of those things just kind of normalized, and the companies that were formed in those 2022 and 2023 years kind of had the hard knock school, like benefits of like, all right, you actually have to make money and you have to be a sound company first and not go super growth scale and then figure out how to make money. And so, the companies who got formed then were very strong, and then the companies who survived started to stable out and get a little bit more stable. So overall, the cybersecurity industry itself had fewer layoffs. But then at the same time, there are other kind of like economic factors happening and other technology advances like with AI, which we'll get into later. But there's a bit of a push and a pull kind of happening at the same time. But I would say, the 2024 like data from layoffs also kind of mirrored, I would say, the funding kind of response back, like broadly, like things were not quite as dire as they used to be.
Yeah, it makes sense. And I think you're right. It's always kind of that push and pull, and there's a lot of factors at play. It's not just one thing, but there are factors that we'll touch on here soon. And I will say, as I was watching the narrative of practitioners on LinkedIn, for example, looking for work or being laid off around that time, it stung in particular because people were talking about well, they just went and raised however much money, right? And then they're laying people off, and it really seemed to people took that personally because they thought, well, you have the money. We know you have the money, right?
Right.
And so people took it personally. And then also, it is amazing that this concept of, oh, you actually need to potentially be profitable and have a viable business. And that's apparently a thing, it seems like now, versus before it was growth at all costs, kind of market traction, customers, et cetera, be damned. It was just grow as fast as you can. Yep. So, you actually touched on some regional shifts too. And I thought this was really interesting because I'll be honest, I don't pay attention to some of the other markets as much, right? The other countries in regard to the job market. I'm curious why the uptick. I looked at this and I saw the uptick in Mexico and Spain and India. And I don't know if it's, is cyber just becoming a much more global market and companies being based in those, those areas, or is it a combination of that and potentially people outsourcing, type of activities? What do you think is driving this?
So I think this is a combination of factors. One, cybersecurity is becoming a bit more global. More countries, I would say, are playing catch up than they are saying necessarily making gigantic leaps. So it's becoming more companies or countries are getting more organized around how they do workforce development, kind of at the institutional level of the country, at the educational level, at the youngest levels of people, bringing them into the workforce and getting them interested in the cyber. So some of these countries may not have had robust programs before, or they did have programs that just weren't coordinated well. So there's parts of that. There's also parts of people looking for lower costs of labor as well. And the talent in different regions are actually catching up in some ways, to be able to be used for more than just low level outsource. You can outsource your second or third level engineering staff as well to some of these places, or do many companies do today, where they'll have a U.S. presence for a sales team, and then they'll have an engineering team in Europe or India or even South America, and to keep the cost of living lower. Or keep costs of employing lower in places that have lower cost of living, and then you can drive in your biggest market where sales matter the most, in the U.S. So that's part of it too. And then, I think the U.S. and obviously saw the biggest reduction, but it's also the biggest market. So it's any reduction seems massive in that space, but also it comes down to there was just a difference of a kind of rollout of how these different economic factors that affected each country and each region. So, and you see that same thing on the kind of the bounce back, they've all recovered differently and at different rates.
Yeah, I think it's notable that they're not, this is not one thing. This is many different countries, regions, economies. There's a lot of geopolitical factors at play. But overall, I think it's good that we're seeing an uptick in these regions. One, for obviously, people being able to lean into the workforce from United States companies and cost, opportunities in terms of having your sales team here that are out there rubbing elbows, those kind of things. Engineering team maybe not here, but also we're going to have more innovation, more startups, more great ideas, more, kind of a more robust, resilient digital ecosystem that's global now, as these workforces kind of grow across the world rather than just kind of in a handful of countries. So, yeah, I think that was a great one there. So let's jump on, keep moving along here to funding trends. We often hear about the resilience in cybersecurity when it comes to macroeconomic cycles. People kind of think cyber is untouchable, and I don't think that that's the case. But it is a bit more resilient. It tends to be cut less than other categories. For example, what do you see here as you were diving into this?
Yeah, I would definitely agree with that. So I would never call it recession proof, but it is very resilient, and it has sometimes when things get worse in the world geopolitically, cyber rises. So there are certain things that it correlates with, and that will always kind of move with it in the same direction. But then when general technology does well, so does cyber. So it's got a couple things that buoy it. It's also one of these things that is kind of an island to itself, much like national security. You still have to do those things kind of no matter what. So there's a piece of it that investments still have to happen. But honestly, this year is interesting because there was a lot more early stage investment that came out and a lot of later stage investment that came out. So the companies are trying to get more innovative with what they're doing. And so they're taking on additional funding or creating brand new ideas or brand new market segments within cyber, because there's so many. But it landed up from 2023. and the distribution was similar too. So it also showed like some good pockets of funding in places that were hurt the most, kind of in 2022 and 2023, in that late stage funding. So that kind of shows like a healthy sign, like, all right, the big players, the older players are back at it again. They're raising money. They're going to be starting to acquire a lot more. They're building new products and gaining market share again. And so it was kind of good to see that rebound, because I track it, week by week, and so it's a race in my spreadsheet every week to see like, oh wow, we could actually beat it this year. So it's fun to watch that.
Yeah, speaking of tracking, like I'm looking at this and like you kind of go through the year, right? But August, what is up? Like, is everyone's off for summer break? Like, what is going on with August?
Coachella. That's where VCs went. A lot of it's coinciding actually with like timing of like summer vacation. So it's they either rush to get it out early or they wait until September, October.
Makes sense.
Yeah, but it's I always joke about it, like, oh, you can tell all the VCs are at Coachella because in August that's nobody does any business, but
things die down. Yeah, that's funny.
Or they just pause. A lot of stuff just waits until like the right timing to release.
Yeah, makes sense. So you talked about this a little bit earlier. You talked about ZIRP. So for folks that aren't familiar with ZIRP, maybe kind of unpack that a little bit. And then it is interesting when you look at this. It's like you realize what kind of an anomaly or unique period of time we were in when it comes to cash raising within cyber companies in the market when it comes to ZIRP. So just unpack this one a little bit in terms of what ZIRP was, why it was such a unique time, and kind of how things have changed.
Yeah, so ZIRP is zero interest rate phenomenon, and it's now that's a term we look back on now in a period of time, effectively from the recovery of the 2008 housing market crash in the U.S., which basically recovered about 2010, up until 2022. We didn't know it, but that was the golden time in cyber and in tech and a lot of VCs, and it was a game time in which there was growth at all costs. It was you always raise bigger rounds, you always raise more rounds. You typically, every 2 years, like clockwork, you raise another round. And then the goal is to get you up to do an IPO. And you were always trying to leapfrog the next best. And the market was also large enough and healthy enough in the spending, like buying capacity, that they would actually support multiple players who do this exact same thing, like very well. Like they could support it because there was room, there was appetite, headcounts. And at least in my time, I got into cyber about 2008, 2009. And from that time, it's for as long as I can remember, budgets and headcount only went up and to the right. And so it was it was the best time. You always got everything approved. Your IT counterparts hated you because they did not get the increases you did. And you're like, but you did. And so it was really like a golden time that we didn't know how good it was until the rug pull came out in 2022. And after that period, zero interest rate. It wasn't zero interest rate the entire time, but it was very, very low. So the cost of capital, the cost of lending money, the cost of borrowing money was extremely low. And so people did it freely. As interest rates went up, the cost of capital to lend and borrow much more expensive. And so you had to be a lot more sure about your investments or what money you would take on, because then you had to meet those obligations, which is why we see like the big pullback and that with I dropped the flag to say, hey, in Q2 was an all out rager after, Q1 in 2022. And then everyone panicked and like pulled deals or paused deals. And then you can see kind of the normalization throughout the rest of the time. And, I suspect we'll probably see this kind of lower tick pattern, because you have to remember, even AI was within here as well. Like AI came on the scene and it still wasn't, in some cases, a third of what the peak was.
Yeah. I think, and I've been digging into, I shared some reports from other organizations. I think it was IONS and Article Search had a good report about, looking at CISO budgets, and they did go up, but they didn't go up like they had historically during that period of time. So I think you're right. We're starting to see a bit of a normalization in terms of spend and investment and things like that. So it's a new normal, as they call it, right? And I think there's a lot of excitement right now around, in the US, at least I speak for the US, administration change, more of a deregulatory environment, things like that. But the interest rate situation isn't what it used to be still. So it's a unique situation still. It's not going to, I don't think the old days are coming back quite like they were.
No, I don't think so.
Yeah, agreed. So, you talk about the early stage dominating the funding landscape, as you see here among seed and Series A, right? Pulling
Mhm.
down the lion's share of investment. Why is that? What do you think's driving that? It seems to be a trend, not just in 2024, but year over year from 22, 23, et cetera.
Yeah, well, I think cyber leans as an industry towards more early stage. Like people are always looking for the next thing, the better mousetrap. They're looking for the better CNAP. Is probably the better way to say it in our industry. Uh, you guys can quote me on that. And the industry needs that, right? It needs up and coming players, and it needs to rethink how we're doing it. Honestly, the industry would not be as far along as it is if people didn't do those things. And what happened when people pulled back in 2022 is, instead of putting your money on a stable longer term company, in some cases some investors took the approach of, actually, let's throw all of our money at these early stage ones because they're our only hope out of this. And so that was one avenue. And then the other half, I would say, said, we're not touching anything new. We want stable cash flowing businesses only that are good and can weather this market storm. So let's put money there. So that's why you see, like in the Series B in 2022, there was like significantly more in that kind of mid stage, like in BCD, than there was in 2023. So that mid stage in 2023 got hit the most, kind of like Series B to Series E plus. But then in 2024, some of those things start to come back. Actually, across the board, they all are up again, which is kind of another healthy sign of like, okay, we can see that these companies are going to weather this storm now. There is no more storm in the same sense that it was, but there's also still a ton of new innovation. So it just got a bit more evenly distributed across time, and I think that's a better sign of like a healthy market in general.
Yeah, I think that's right. And as you talked about in the previous slide, I think people start looking for stable cash flowing businesses that are, kind of profitable and sustainable, things like that. So that's probably what you kind of were touching on there with the mid, kind of B through E rounds. And then also, I think there's, we'll talk about this too, I suspect in a moment, maybe, but like I said, I've been digging other reports from, YL or Night Dragon, other firms like that too, that, kind of do this as well. And it seems that a lot of exits are actually happening earlier too. So I suspect there's not maybe as many mature, further along series companies because they've kind of been acquired at that point or something like that, where, we have a lot of activity in the early kind of startup incubation type phases. So I suspect that may be playing a part too. So you call this the great reset. It says early stage is cool while late stage rebounds, which, as I was reading this, it seemed kind of a contradiction to the previous slide to some extent. So I'm curious, like, help us kind of understand this one.
Yeah. So if you look at the sheer numbers overall, like it looks like early stage is going down, but the distribution of deals is different between all 3 years. So like while early stage is less, it's still high relatively to like the other segments like within 2024. But then if you look at the late stage, that is up quite a bit. It's actually higher than 2022 in this area. And it shows like what was becoming like a rebound effect in the later growth stage companies that are now, they've survived the kind of economic torrents and the different changes. Some of them have acquired some of these early stage companies, and so there's still good healthy distribution. But obviously the bigger companies will make the later stage companies will take on bigger funding rounds, but far fewer of them at the same time as well. But yeah, I think this just kind of shows that like, that late to mid stage, then that area is still very much back in this space, in addition to like growing early stage. But it's not so much that you have to put all of your money in early stage anymore, because that's your only way out, I would say.
Yeah, that makes sense. I was, this may be a naive question for someone who isn't in the data as much as you, but is it possible that, due to the kind of stagnation around IPOs, we see these late stage companies need to seek investment because they don't have the public market as kind of a pathway right now?
Yeah, there is definitely some of that, and that actually happened quite a bit in 2022 and 2023. So, there's a classic case of like Arctic Wolf, took on like a $400 million debt round in like 2023, which in other usual times might have been an IPO round. And there's still rumors about them going IPO this year or next, but that's one of those things that companies started doing a bit more, or they kind of did some of these like venture rounds, like kind of not stage specific. Like you can take a generic venture round at any stage you want, early or middle or late, and then that's how they kind of evolved.
Makes sense. Okay, so I'm going to move us on so we can kind of hit the full report. And again, for folks following along, this is just like the highlights. He did a really comprehensive write up on this, so I definitely recommend reading it. I'll drop a link to that in the show notes and things like that for folks. But for M&A trends, like let's take a look at this. It says consolidations were in style again. And when I read this, when I heard consolidation, I immediately thought of all the talk we heard about platform versus best of breed, and how people were starting to push into kind of quote unquote platformization as a term. Like we see the big vendors like CrowdStrike and Palo Alto making that play, and trying to get people to consolidate budgets. Right, too many tools, security tool sprawl. I'm kind of rambling a bit, but I'm curious if that ties into what you're kind of demonstrating here.
No, that's exactly it too. Like it shows that the late stage companies said, hey, we got to start buying more, we got to innovate more. We need to consolidate. If you looked at, especially the public companies, all of them moved to a platform play. All of them sprung out of the woodwork and said, yeah, we have a platform too, just like Palo Alto, just like, insert any CrowdStrike. And, that became kind of the norm of bringing that back in style. And so that just, that drove a lot of the M&A transactions that this year. And that's why it ended up higher volume and higher dollar amounts as well.
Yeah, it makes sense. And I think just a note on that, like, I've written some articles on this, like there's no right or wrong answer. It depends on your organization, your budget, your team's bandwidth and capacity and expertise.
Right.
You'll see different patterns among organizations based on their size and maturity in terms of many tools versus a platform. It just really, truly depends. So there's no right answer to that one.
Agree. Yeah.
So this one here, you talk about the early bird gets the worm, M&A worm, when you talk about percent of acquired companies by latest funding round. Again, this kind of talks about what we talked about earlier, like early stage exits seem to be the norm, which is, again, I saw similar kind of trends in the other reports that I was digging into. But, what are you seeing here?
This to me was really around competitive urgency. So like it changed between 2023 and 2024, like pretty significantly. Companies are looking earlier and earlier to either fund, or they're looking earlier and earlier to acquire either talent, a team, an IP, contracts, and anything that complements them. So, some of that was opportunistic, meaning like the companies they were looking at needed a lifeline, and they just needed to get them out of there. And they saw like an easy play. And then others were truly strategic, and then they actually complement something extremely well, like an existing product suite, in a way that rounds out like a whole offering for a larger company, like a high growth company. So I think this will continue. I think especially, not to be too buzzwordy on AI, but I think that will truly accelerate the need to do this quicker, because it is such a fast changing field, and you can. The fastest one to the market in some of these cases, kind of, especially with these AI use cases, tends to win a very big piece of it. It's not true in all of cyber broadly, but it seems to be true in these early-ish days of AI and cyber together.
Yeah, it makes sense. And I saw, like, again, in other reports, it was the companies that raised fast, grew fast, tend to get acquired. They may be able to beat out competition in terms of being picked up by some of the more industry-leading companies that they want to work with or be a part of. Mm-hmm. And of course, many founders are coming into this with the ambition of getting acquired, having an exit, that kind of thing. Yeah. So that was really interesting too. And I think you're right. It's going to be a trend that continues when we see AI, kind of playing a role, which we'll get to here in a moment too. You talk about this cluster here, the big get bigger, M&A activity clusters in the 100 million range. Why do you think this is, and what exactly does this mean?
Yeah, honestly, this, Israel kind of set the bar on a lot of this, where there's basically the standard, acquisition was 300 to 500 million for a company that was like around Series A, that had super high growth. And, there's not a lot of transparency on like the ARR numbers or annual recurring revenue, but there was a lot of pickups in that range, moving quickly to secure exact talent and just kind of market share. And then, the very large acquisitions came back. The big private equities were buying, very big companies. There were, 9 deals that were over $1 billion this past year. And that's very similar to 2022 and before. So like a lot of strategic big acquisitions, inside of cyber with private equity, or outside with like MasterCard and Recorded Future. So there was quite a bit of those. And so that's kind of another good sign of like a healthy market range.
Yeah, it makes sense. And, I think the transparency piece, which we're going to talk about, I thought was interesting. So You said, cyber M&A transparency continues to decline. Why exactly, obviously this is different than publicly traded companies. You can't really get the figures or the data. You and I are in a chat with some other folks where every time some kind of deal goes down, we're all speculating on like, is this good or is it bad? What does it mean? Like,
Yeah.
what did it mean for the founders and the early team, et cetera? Why is this transparency piece important? And, kind of how does it impact your ability to kind of analyze these deals?
Yeah, honestly, it really kneecaps the ability to analyze the deals because overwhelmingly the deals are not transparent. But the challenge is there's not really any legality around saying that it cannot be transparent. It's usually just like confidentiality agreements and then just like secrecy in general. It's kind of a practice norm in the industry. But if you talk to any investor, the number one bit of information they want to know is like all the private data from other transactions, which are hard to come by. And so it makes it, you truly don't know like what your company's worth. You don't know what you're kind of relying on these intermediary brokers like investment bankers and others to guide you along the way. And that can have self-serving motives also as you do those things as well. Like, you can go to an investment banker conference and they'll tell you M&As are on the rise because that's their business model. So it's like, they're not wrong, but it's also, it's not exactly transparent in a lot of ways. And that's kind of, my goal is to make it transparent in the ways possible so that I can help the whole industry just be kind of more aware of what's happening. So I'd love to know more, but it's, I think it's a tricky problem.
Yeah, it's a lot of nuance to it in terms of the incentives that are at play, depending on the persona or the entity involved, right? Like some other founders want to know because they want to know what they're valued at,
Right.
compared to peers. Others that maybe on the investment side don't want it disclosed, maybe because they got a good deal and they want to keep getting good deals or something like that. There's just a lot at play that could be at play there. So next up, you have AI and security. Like, this was definitely the year. Last couple of years in general, but the past years, like, everything has been AI.
Yep.
Like whether it's securing AI or using AI to solve systemic security challenges in cybersecurity, you name it. And like it seemed like every startup, this is a overstatement, but every startup I looked at, it was like, oh, AI startup.
Yeah.
Like it was just all over the place. So what are you seeing here? What are the numbers saying?
Yeah, so these numbers are just the companies who came out with like a stated mission around like we're doing AI and cyber, or cyber for AI, or cyber from AI and things like that. And so this doesn't even include the probably countless amount of money spent on companies injecting AI to existing products and suites and all that. So these are just the ones that are come out of this, and it had a pretty healthy growth, like almost doubled year over year. And I think that'll continue on the trend as we go. More companies are coming out with better use cases, more narrow use cases around AI and security. They're actually figuring out what customers want now. There's always been kind of a bit of a divide in between like what the industry has given versus what people can consume on this. I think, to be honest, I think agentic AI is going to follow the same way. Like there will be available options. They will be hard to put into practice for the average business. Like it's not that good yet. It will get there. But the similar kind of thing is happening with AI. So, use cases got a bit smarter. Companies got a bit tighter on what they do and what they cover. And, it's like forming new categories all the time because there's an entire privacy and safety aspect to AI that is unique to a lot of the other spaces that kind of cuts across spaces that a cyber doesn't often touch directly. So I think we'll continue to see that going on. But then with all the hysteria, I wanted to show this chart just to show that it's not really that much. Like if you zoom out, like data protection and, some of these other core identity services, like they still make up the bulk of the industry, even if they have now with AI. So I thought that was just an interesting kind of year over year trend.
Yeah, I think this is a good insight because, like you said, I kind of thought AI just totally dominated. And I looked and it's like, okay, definitely, it was a unique factor and it played a significant role, but it wasn't everything, right? It just sometimes feels like it when you look at the media or social media or news outlets. Everything seems like that, and you realize, oh wait, there's still the broader cyber ecosystem that's not going anywhere. And then your comment about categories. I'm sure everyone's kind of cringing because, we all love our acronyms of SaaS, DAST, SCA, CNAP, CWPP, on and on and on. It's like, okay, so more acronyms to come, folks. Stay tuned.
Yes.
So the AI security gold rush, early stage funding doubles. It looks like, this particular, again, is a kind of an emphasis on the series that organizations are at, or your startups are at, what was this showing?
Yeah, there were just a lot more startups that hit the scene this year. Early stage startups in AI. So like, I I need to look at the actual figures, but like they more than double the actual amount of companies that were in the space. But there was a lot more investment put into it because for the early part of the AI wave, it was almost impossible to not make a pitch without having AI in it. And if you weren't investing in AI, well, then what were you doing with your money? You weren't making good financial the decisions. So like a lot of that kind of feeds off of each other and builds into itself. But there's a bunch of really great stuff has come out, and then you start to see some companies who kind of maybe that early wave. Maybe they started off as machine learning, and now which is often goes hand in hand with AI, and so now they've got a really good proven business case, and now they're growing at the Series B at like later kind of stages. So you're starting to see that. So I imagine this will continue on, and like next year we'll see a bit more categories throughout or ranges throughout that as well.
Yeah, I think this kind of speaks to what I was saying before. It felt like everything was AI, and it was because the startups, the organizations that were coming, kind of out of stealth or announcing whatever, so many were AI centric. And to be honest with you, like I know many of them, the folks that they're doing this, and there's some amazing people, like repeat founders, first time founders who are incredibly experienced. And it's just going to be exciting to see, like, who kind of accomplishes what. Who pivots or doesn't pivot, maybe some of the people who are pivoting now into this space end up beating the folks who were first entrants. It's just going to be interesting to see kind of how it plays out over time and what kind of takes hold. So yeah, it's going to be a good one to kind of keep an eye on. So this one's a hot topic, product first services. And often you hear like kind of don't mix the two if you're a company. So I was looking at this and it seemed like product rule, you kind of came up with your own acronym here, PREAM. Product rules everything around me. So distribution of funding, in cyber by products for services, it shows that product, just completely dominated. Why is that? Why is it, margins and things like that? What drives outsized investment in product companies?
Yeah, a lot of it's around the business model itself and like how it can be scalable. Services are typically human scalable, so you have to throw more bodies at it to serve more customers. And software, you don't. You just add in more customers, and the more customers you get, the better your run rate is. And so like that's services typically not been venture scale businesses because of that. So because also with services, there's no consistency in revenue. So like you can sign a 3-year contract or sign a 10-year contract if you're in the federal space, and then you may have nothing after that. So you can't really predict revenue over time. So then you can't predict growth, and you can't predict, like, you can't set goal targets in the same way. But that's still starting to change. And to be honest, if you look at this from like another lens, like the services make up probably the majority of the industry itself. People just don't see it that way. Like their services, like helping with the products, or they're delivering managed services that are actually like managed products of something else, or they're a private label version of another product they bought. So it's interesting how it's not focused on, because it's not as sexy, and they're not like private or public companies, and they're not like what the big equity analysts follow, but it's the majority of the industry.
Yeah, I think, man, I'm glad you said that. First off, I own a services company, so like I live and breathe that aspect of it. And there's some unique nuances to it too. Like, for example, like services company, it's much easier to kind of bootstrap and get going and scale it earlier on, right? Where with product, you need, you need some significant investment for R&D, for engineering team, a sales team, et cetera. Where services is definitely different in that regard. But again, the margins, the growth, it's just a different animal. And I think that, what you said is so important too, in terms of services is such a critical component of this ecosystem, because a lot of people think, you just buy the product and you're doing, whatever, zero trust now. It's like, no, it's actually like, there's a lot of actual work that still needs to be done, whether the organization's doing it internally, the product vendors, doing some kind of customer service, customer success type model. They're working with a channel partner, whatever the case is, those kind of things to ensure the product is successful and quote unquote sticky with the customer. So there's a lot to it too. And then, one other thing I want to get your thoughts on is, we're now seeing people investors take aim at the services market, because they're looking at services as a software with agentic AI is kind of the buzzword right now. And you see Sequoia and other folks, Insight Partners, et cetera, talking about this. How do you think that's going to play out? Do you think we're going to see, kind of agentic AI kind of eat into a good portion of the services market?
Yeah, no, I think it's a huge market to take on because it then becomes you have the ability with like that level of AI and agents to productize service things that once were like human driven things. So obviously you can't replace all humans with this, and I don't think that should ever be the goal. But you can productize certain offerings in like a repeatable way. But no, I think that will absolutely drive into that and what's possible now with a small team and with the right AI tools is it's truly incredible, like what you can do now. So I think that will only get more attention from investors.
Yeah, I think as you said, it was kind of a portion of the market that investors just didn't look at historically. They didn't seem to think it was a good kind of space. But now with agentic AI, they're saying, there's this untapped market with
Yeah,
a significant portion of revenue that we can maybe now target. It'll be interesting to see how that goes. Again, with another acronym, we got services with acquisition growth.
I
So
had
this
fun
one
with
looks at
these.
this. This one looks at distribution of M&A activity for cybersecurity products versus services businesses, and it looks
Yeah.
like services are leading consolidation in terms of this. So what's different about this versus the prior slide where product kind of dominated?
Yeah, people. I think this is often like shocking to people who aren't that close to the industry, but it's like the majority of M&A is one service company buying another. Because that's the easiest way to scale. That's the easiest way to enter new markets. You can't quite do that with products because products are typically have more defined edges, and services can be anything. Like you can just we acquired this service and now we do pen tests, and like that's it. You've integrated the service itself. So I think that's a good way to do it. And then a lot of these services businesses make a lot of their money running the products that these companies are on behalf of customers. And you've seen a lot more companies lean on service-based businesses and managed services to just get their normal cyber work done. Like they can't get it all done either from headcount limitations, and then buying a service versus buying a product comes out of your financial statements differently. And so you can spend money whatever's in favor of that day. You can spend the money out of one bucket and not the other. So I think a lot of companies have moved to like as a service model because it's easier to consume, easier to ramp up or down. But we still saw a huge amount of M&A transactions around services businesses, and I think that will just continue to go, especially as companies tend to look to more of services and software together to make like a more kind of cohesive offering.
Yeah, I think those points are spot on. Again, we talked about kind of scaling a product for a services company. As you said, kind of buying another services company is a really quick way to grow versus kind of growing organically as a services company. And as you said, you buy it, you're automatically kind of doing, quote unquote, doing the service. Where if you buy, if you're a product vendor and you buy another product, you got to integrate it into your platform,
Yeah.
your quote unquote platform. You got to make sure it works well with what you've already built. You got to kind of introduce it to your customer base. There's just a lot more nuance to it, and it's not always done well.
Right.
So that's a problem too. So, jumping down here, geographic trends. I lost my video, so bear with me. I'll fix that.
No worries.
So geographic trends here. It says the U.S. dominated while Europe, Asia, and the UK stepped up. And you and I were talking about this offline a little bit. And the U.S. obviously is like the dominant player, but some of these other markets are interesting. I think people are taking note of this slide in particular and kind of digging into it. So I'm curious, what was your perspective looking at these?
Yeah, this is the slide that's gotten the most comments, and it was kind of one of the more fun ones to make. But I wanted to see what was available publicly available across the world and where I could attribute it. So I track like a couple hundred different cities and states and countries and continents and across the board when I track all this data, so I can do stuff like this and see where things are growing. And you can see the U.S. is always outsized just for the sheer fact that it is the largest market to sell to. It's the largest buying market in cyber. And many companies, regardless of where they start in the world, they end up moving to the U.S. So like it gets heavily weighted no matter what, no matter how you slice and dice it. But there's a lot of companies or a lot of countries and regions who are trying to compete with the U.S. in that space, but then also just grow a local ecosystem as well. You see this a lot in Europe, where countries are trying to grow specialties, trying to build. You've seen this with AI, where like semiconductor manufacturers too. It's a similar kind of thing. They want to build, resilient and like thriving economies. And you can't talk about the economy without cyber. Or at least I can't. So that's you have to bring them together. And so that's a great way to do it. But it shows a huge disparity too of like where is there not investing, or perhaps where is it not venture capital money, because to have, and this is something I was thinking about as I made this, to have a healthy venture capital and private equity ecosystem, you have to have a stable financial ecosystem, number one. So you have to have banking, right? Everyone has to have the ability to bank and do transactions. And it's just not distributed the same way across the world. Even to this day, like, in certain countries or certain regions, like it's still not as seamless and ubiquitous as like tapping your credit card and going somewhere else for every transaction. So the other higher level financial instruments are just not there yet, and they may not ever be. And then some of them just may be completely private. We have no way to know, what's happening behind the scenes. So I've got way more detail on this data as well. So I'd love to, if anybody wants to know more specifics, I've got hundreds of other cities to look at.
Yeah, definitely. As I said, I'll be sharing the full report with folks in the show notes. But I thought this one was interesting for a few reasons. As you said, like I like the aspect of geopolitical stability, economic stability. All those things need to be in place before you can kind of have a cyber market, quote unquote.
Yep.
And then of course, Israel again. We talked about this a little bit offline, but as a single country to kind of have 6.3 of the market, 6.3% of the market, compared to some of these other places, which are much more bigger in terms of population or regions or things like that, it just really speaks to their outsized impact in the ecosystem. And then the last aspect I was going to touch on is Europe in particular. It's an interesting one, an interesting dichotomy to me, because on one hand, some investors don't target Europe, the European region, that kind of thing, EU, for example, because of all the regulations and things like that. They don't see a lot of startup opportunity there or innovation opportunity there. But at the same time, we do know that compliance and regulatory forces drive security investment and spend, right? Because you have to meet these regulatory requirements. So on the other hand, again, it may be a compelling market because they have to do certain things. Where in the U.S., it's a lot more voluntary, best practice, kind of voluntary type driven scenarios. So really interesting stuff. And so we've run the gamut here in terms of everything from economic trends, M&A trends, the AI effect in terms of what's driving startups and the number of startups that are focusing on AI, products for services, and of course the geographic breakdown here. So for folks that want to dive in more, I'll definitely share a link with that. And then if you haven't subscribed already to Return on Security, that's returnonsecurity.com. And you can check out that website as well as give Mike a follow on LinkedIn. He's always sharing great content there. He has a great newsletter. So Mike, thanks so much for coming out again, man.